Hi viewers, in this video I am going to explain about the mutual funds. What are the common types of mutual funds? What are the risks involved in it? Is mutual fund is better than fixed deposits? What is mutual fund? Mutual fund is nothing but you are investing money in different companies and the money is managed by mutual fund companies. Okay, you are having money in your hand and you want to invest those money in the share market. Okay, so those monies will be managed by the mutual fund companies. Okay, so see, this is the basket, mutual fund basket, and here you see you have three stocks: Axis Bank, Tata Motors, and IOC. Okay, you are investing money in the mutual funds, means you are investing money in these three companies. Okay, three companies which will together called mutual fund basket. So how mutual fund works? See, getting money from many people and invest in basket. So this is what mutual fund companies do actually. So this is the basket I said. Okay, it have the Axis Bank, Tata Motors, and IOC. Okay, so this mutual fund company, what it will do, it will collect money from the investors, and this basket will be managed by the mutual fund company. Let us say we have the client or we have the investor Ramesh, which he is investing 5,000 rupees. So second investor is James and he is investing 10,000 rupees, and third Irfan is investing 2 lakh rupees, and Ravi he is investing 50,000 rupees, and Suresh he is investing 10,000 rupees again. So they are all willing to invest money in the mutual fund, especially in this mutual fund baskets. So the basket will be managed by the mutual fund company. The total investment is 2,75,000 rupees. So mutual fund companies, what they will do, they will take this 2,75,000 rupees and put it in this basket. Okay, so mutual fund companies, they have the mutual stock market advisors and the financial advisors are there. So they will analyze the market and they will analyze the particular stock and they will put it in a single basket. Like this is the basket which have the Axis Bank, Tata Motors, and IOC from the three different sectors. Actually is the motor company, Axis Bank is the banking sector, IOC is the Indian Oil Corporation. If one sector fails, other sectors will grow up. So depends upon the scenario of market scenario, this mutual fund will rise up and down. Let us say the investment ratio for these three stocks will be 1 is to 2 is to 1. Here the Axis Bank will have the ratio 1 and Tata Motors will have the ratio 2 and IOC will have the ratio again 1. So when we are adding up 1 plus 2 plus 1, it became 4. So we are dividing 2,75,000 total investment amount divided by 4 is 68,750. So the investment ratio here becomes 68,750 multiply 1 is to 68,750 multiply 2 is to 68,750 multiply 1 again. So it becomes 68,750 is to 1 is to 1,37,500 is to 68,750. So here the Axis Bank, the mutual fund company, they will invest 68,750 in Axis Bank and 1,37,500 rupees in the Tata Motors and 68,750 in the IOC. So depends upon the market scenarios, these stocks will perform ups and downs. So your mutual fund amount will get reduced or increased based on this. There are three common types of mutual funds. Okay, so there are different types of mutual funds in the market actually, but the most familiar three common types are equity funds, debt funds, and balanced funds. Equity funds are nothing but you are investing money in the stocks of a company like Tata Motors, IOC, and Axis Bank. The mutual fund companies, they will invest in the mutual fund basket which have the stocks of the company. Debt funds are nothing but the mutual fund companies, they will invest your money in the government bonds or the corporate bonds. Okay, so what are these debt funds, what are the equity funds, or the different types of ones, I will explain you in the different video. Okay, so balanced funds are nothing but they will invest both in the equity funds and the debt funds. Okay, so the risk involved here in the balance fund will be the average of equity fund and the debt fund. Risks of mutual funds. Okay, if you see the mutual fund advertisement at the end of the video, they will play an audio. Just listen this, I will play for you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
First one is equity funds, which have the higher risk actually. So usually it will have the 40 to 30 to 40 percentage or 40 to 50 percentage returns, but it have higher risk involved in it. The second one is debt or bond funds, which have low risk, which is the returns will be little bit higher than the fixed deposits here. Balanced funds have the medium risk, which and also it have the medium returns as well. Since it is between the equity funds and the debt funds, so the risk involved is medium and the returns also medium here. Zero risk. If you want your invested amount in this zero risk factor, so I prefer you to invest in the fixed deposit actually. So mutual funds are purely subjected to the market risk. Okay, so you cannot blame anyone. If you invest in a mutual fund company and that company fails, means that is depends upon the market scenario. No one can predict that one. Okay, you are investing 1 lakh in a mutual fund, but the same company, the same mutual fund advisor who suggests that one, they will also invest crores in it actually. Okay, you are investing 1 lakh rupees, they will invest 1 crore or 10 crore in the same mutual fund basket. Okay, what they are predicting is this fund will perform well. Okay, unfortunately the stock will go down. It is not it's like, no, we cannot blame anyone. But if you are, yeah, if you already invested or if you are planning to invest, you have to be very patient. Okay, you should be a long time investor. Okay, if you are investing in something and you want the money has to grow in a year or something, it won't happen like this. Okay, it will take time. It will take time, like at least 5 years you have to wait for. Okay, if you can't wait, I don't prefer to go for the mutual fund. Just invest in the fixed deposits. Okay, I'll tell you an example here. Okay, I already taken the Tata Motor stocks for you. Okay, this is the 1 day chart. Daily, this is a daily chart actually. So daily the stock will go up and down. If you see, in 2016 the stock price reaches 590, 594. Okay, so if you see in 2017 it came to 472, 470 something. Again it rises, but it reaches only up to 550, and there is a fall actually. It comes to 373 or something. Again it, see, it's a big fall. 2018, when it touches the 2018, see the stock, how the stock is going down. If you invested something some amount in January with the amount of 433 as a stock price, see, end of the year you will have 169, and it comes all around 156 something. Okay, this is the market risk I am telling you. Okay, no one can predict the market. I remember that most of the financial advisors are gave the strong buy signal at this area. Okay, when I see like in the October, November, October, not November, September and October, most of the financial advisors in the major financial websites, they are recommending the Tata Motors actually. So at this price, actually 250 something, but there they analyze the market well. They know the technical things. Apart from that, there is some factors which will drops the share down. That is market sentiment. Market is purely based on sentiment actually. So no one can predict the market. Okay, so see, from 250 again it went to 150. Okay, the price may go or may not go. No one can predict that one actually. So this is the market risk. This is the market risk you are going to take. Okay, so just analyze the market by yourself and uh, invest in the mutual funds. Okay, it's up to you. Okay guys, thank you for watching this video. If you like this video, please subscribe and comment. Thank you. See you in the next video.